Hi guys, welcome back to my IG. Remember Mr. Minor? Say hi.
Hello everyone.
Mr. Minor is the GM at Apollo, actually specifically the asset management. It basically means he's just a super duper investor, and that's why we're talking to him today. So today we are learning about specifics on money market funds, specifics on Saccos, and specifics on banking. And Minor, to just go straight to it, I guess maybe give us the guidelines, pros and cons. What is a money market fund?
All right. Now, thanks for the question, Ivy, and the kind words. We just do what we can in terms of investing, but to get right into it, a money market fund is a collective investment vehicle, and what that means is it's a fund which allows many individuals who are typically conservative in their risk profile to put in their investments. So imagine 100 IVs, 100 minors investing in a money market fund. We all share a conservative risk profile. We don't like that much risk. We are able to build our investments within that fund over time, but because now it's 100 minors and 100 IVs, those pooled funds together can be invested in a way which suits all of us in terms of our risk. So as the asset manager, we are able to obviously negotiate better rates for those investments than we would probably get as an individual walking into a bank. And that's really their, I say claim to fame as far as making them a preferred investment is concerned. Now, banks will typically tend to offer lower returns in terms of their interest products. So that's a key differentiator between the two. You'll find on average money market funds will generally give fairly attractive rates of return.
Why? Is it because there's 100 minors and 100 IVs? So
I think they invest in a lot more different types of assets. All interest bearing, but when you have the ability to pick some high interest investment assets, a nice mix of lower interest investment assets, typically when you blend all that together, your return should be higher than the bank return. The other thing which is the differentiator between the two is typically more flexibility on a money market fund. So any fund that you invest in the market, you will typically be told you can access your funds within 2 to 3 days, right?
Sometimes even immediately.
Exactly. Nowadays with the movement towards digital, you can literally just through your phone either invest or disinvest your money, which I think is a lovely thing, right? But on the banking side, typically, if I place my money in a fixed deposit, I don't have the luxury of being able to get my money back before the period is over. And to the extent, in some cases that happens, you may have to forfeit, the interest that you've earned up to that particular point. So the flexibility of money market funds is something which I think a lot of people like. And that's, something which has given them that preferred asset status.
Damn, Mr. Man, I think what you just told me is I need to go to my bank and negotiate a good rate for a fixed deposit, because the reason I don't like money market funds is because the money is so easily accessible. I don't like that, and I think I'm that type of person. And if you're a mover who does not like that, maybe we need to go to a fixed deposit and put our money there and lock it for like 6 months so that we don't touch it.
So actually there's different ways of approaching that. Even with the money market fund status, right? There's that discipline element, which is one of the hardest things we all have to deal with on various fronts, right? But a lot of money market managers allow you to open multiple accounts, right? So you can open an account which, account one, it's IV1. IV1, you can, lose your discipline a bit and dip into it. IV2 is more of, this one, and it has to be extreme circumstances before you get into that. And the other thing which I like to encourage people, even as you do that, is link IV2, the one which you don't want to touch, to a specific goal in the future. That really helps in terms of making you remain honest to, your track. And the goal could be anything. It could be a trip in December. It could be putting a down payment on something. Many times once you link that to a specific goal, you'll find you're a lot more disciplined about how you approach that account. So, that's just one way you could try and manage that discipline. But sure, the banking side, like you put, for sure that one will, you're not going to be able to access your money until, the period is over. Which, for those who have the discipline issues, might be the way to go. It really varies.
What is a Sacco?
So Sacco comes from the savings and cooperative movement.
Yeah.
Really, it was a way for encouraging a broader set of investments from people. So, you know, I guess the way economies generally develop, there is the white collar, you know, approach in terms of people who generally have access to a lot more, call it investment products.
Yeah.
And then, you know, you have blue collar and so forth, right?
Yeah.
So savings and credit societies were a way of aggregating savings funds by people either in a specific profession or in a specific sector, right, which allowed them to be able to put away some of their money and also had some element of accessibility to it, right?
Okay.
So, you know, I remember Saccos, for example, aligned to teachers growing up. You know, my mom would put away some money in that, and she loved the whole idea that, you know, she could put it aside, you know, forget about it, but would get her statements and be able to see some growth there. And I think I also got that bug from her in terms of just putting aside money to be able to save. But in general, you know, they are, you know, obviously regulated by SASRA, who's their regulator. It's really just a way to broaden the savings. The terms might vary from Sacco to Sacco in terms of accessibility of your funds. But in general, you know, the ones that, you know, have the good corporate governance principles are also a very viable way to save. And again, just another savings avenue. I always say, you know, you can diversify your saving. You can have some money in a money market. You can have some money in the bank. You can have some money in a savings and credit society, for example. Really, it's just about doing a bit of research around, you know, if it's the banks, what rates are they offering? If it's the money market funds, also what rates are they offering? How quickly can you get your money back if you need it? And the same thing with a Sacco, right? Are there any penalties if I access my funds twice in a month? It's just doing that research. But all very viable ways of saving.
Okay, fantastic. Someone was saying that the reason they like saving with a Sacco is because they'll get very low interest rates on loans. What would you comment on that?
Yeah, you know, it's definitely a viable reason as to why one would want to save with a Sacco. More accessibility to credit, you know, for whatever reason one may need the credit for. And with them, I believe there is also the element of being able to access more capital if I demonstrate that have essentially serviced my loans better. And clearly it's easier to service a loan whose cost is lower than a higher one, right?
Of course.
I think that's why, you know, people also like it. You know, you demonstrate that you can consistently save. Then against your saving, you can be eligible to take loans of certain amounts. I think that's a huge attraction point for various investors.
Would you be able to tier it for me from number 1 to 3? What's the best place to save your money? Is it a money market fund? Is it a bank, or is it a Sacco?
Hard to rank them that way. I mean, given, you know, where I'm positioned now, I'd say money markets offer you the flexibility. So I would be biased probably towards those. But honestly, I'd say being diversifying your savings is just something I recommend in general.
That's a key lesson. Right now, what's the best money market fund in Kenya? Just tell us. And
again, you know, tough questions, Ivy, tough questions. No, I'd say, you know, all money market funds are supposed to, you know, essentially give you a conservative investment profile of saving. You know, I'd definitely say, you know, the Apollo money market fund is worth checking out. But in general, you know, they are all more or less supposed to give you the same ability to save and invest. And again, I'll go back to that thing of diversification. You know, you may have a money market fund with a particular provider. I think I would encourage people to also look further afield. It doesn't hurt to have 3 different money market funds, for an example, right? It just gives you a chance to diversify your return profile. And that whole adage of not putting all your eggs in one basket, you know, I think is useful. Just to keep in mind on that front.
Maina, what if I want to put my money in a money market fund, then I see they're offering me returns rates of 15% per annum, 17% per annum. Is that a red flag?
Yes, I would definitely be cautious. You know, it's a brilliant question because I'll say this again and again. You know, a money market fund is supposed to be a conservative investment. Because it's conservative, even the returns you'd expect should be positive, but not stratospheric, right? You're not talking about double digit in a crazy way. Because then you have to ask yourself, if even the riskiest bank in the country is giving rates that are under 10%, how am I able to get 17, right? So to the extent one is actually going to consider, you could be a risk lover as an investor and you say, you know what, I'm going to try my hand. It's a good idea to, try and kick the tires a little bit and ask some questions like how are you able to get that rate? What is it that you're doing differently that positions you to get those kind of rates? And usually, if it's on the up and up, then the answers should be very direct around that. But if I'm kind of dodging you and not really telling you how, or not able to explain, then it's worth maybe pressing pause on that. So yeah, I'd say money market funds, conservative. That's the whole idea around them, right? Riskier investments means it's maybe not really a money market fund, might be something else. So worth considering.
Okay, fantastic. I think the final thing is something that we were discussing with Maina earlier, and it's something I want to tell the movers. When you're looking for places to invest your money, Mr. Maina summarized very well. He said you have to do your own due diligence. So we're here to guide, yes. He will say his opinion, yes, but you have to do your due diligence. Why is that so important?
I think we, just before the interview as we were setting up, you referenced how money is a very personal thing. Right? And because you're the one, like you said, who knows how hard you worked for the money, the sleepless nights, the sweat literally you've put in towards getting that resources, then you really owe it to yourself, right? To get to understand what the investment avenue is a little bit more, right? Sure, investment advisors help in terms of giving some guidance, but that doesn't absolve me or you of our own responsibility, given it's our own money, right? To just do a little bit more research about things, right? And I think that also tends to give somebody a better sense of comfort, that you're not just acting on maybe advice that you've not quite also checked out yourself. And that can also help you, going forward in terms of either diversifying your investments or even increasing your savings. There's a huge sense of empowerment I think people get when you actively have a say in how you invest your funds, right? You can say for whatever reason, I'd rather do it in this bank versus that bank because of X or Y, right? It's a personal thing, it's a preference thing, but the empowerment that comes from that you can't, imagine. I think it's really sets the pace for your future, management of your resources, and even how you would teach, whether it's your children, to really be a bit more introspective around what is it that I'm looking at here, right? So I think it's important to do your own due diligence, and that cuts across investment. It cuts across even shopping for appliances. Before I go and buy a fridge from here, what are fridges over there looking like?
Especially big purchases. It's not chewing gum,
Exactly.
But before you buy a fridge, do your homework. Buy Samsung.
It's important, right? And when you've done that research, even as you're gaining that utility from that asset that you've bought, right? There's that thing of like, what, I chose this after some considered thought. That pride of ownership really feeds in. So it is important to do it.
It decreases also chances of buyer's remorse because you made a very informed decision.
Exactly.
Okay, fantastic. Guys, that was money market funds, banks, and Saccos. So next time, Maina is going to talk to us about real estate, land banking. What do you guys need to know? See you.